Welcome everybody to our monthly special presentation. Today, Jason Civalleri, Esquire, is going to make a presentation for us.
Hello.
Jason is an expert in data privacy and blockchain, who's been working in the decentralized space for over 5 years. As an attorney, he represents some of the most renowned exchanges, organizations, and startups working to bring us closer to a decentralized future. He's also the chief compliance officer of MyCrypto, a prominent wallet serving the Ethereum blockchain community, and is an adjunct law professor at the University of New Hampshire, where he teaches on the intersection of blockchain and data privacy regulation. Jason was a co-founder of the Splitcore Foundation, a nonprofit dedicated to using blockchain technology to take down Amazon with easier, safer, more private, and cheaper online retail e-commerce experiences. The title of Jason's presentation is Blockchain and Crypto, Not Just Bitcoin Anymore. Please mute yourselves and welcome Jason.
Thank you so much. I'm glad to be here. Let me get my share screen going. Sure. Okay. And voila. Okay, so yeah, as Cindy mentioned, I will be going through what I see as the most exciting aspects of this technology. Usually when I talk to people, they just think of Bitcoin. That's probably the most prominent crypto, what they call a cryptocurrency in Bitcoin's case, and gets the most attention. It's also the highest value. But for me, Bitcoin came out 12 years ago and is really focused on one single functionality. Meanwhile, the entire industry has exploded in various uses of the tech. So I'm going to run through sort of where this fits contextually in the history of communications, as well as how the tech works, and then some of the cool stuff we're working on. So with that, legal disclaimer as a lawyer, this is not legal advice, et cetera, don't sue me. All right. So to begin, one of the most powerful things that happened in a human evolution was the invention of writing, where we could now transmit communications in fixed form between individuals. Before that, everything may have been mostly audible, speaking to them. And obviously, when something's audible, you can't record it, or at least before we had methods to record it. It was just, you were either there when it was spoken or it disappeared into the sound waves that no longer carried it. And so early on, you see different forms of writing, but quickly we realized writing had some issues. I think one step I missed is that one of the important advancements of writing was the concept of ledgers in math. This allowed business owners and merchants and anyone engaging in commerce at all to, rather than just create exchanges in the present, they could record their history and their transactions. And they could even perform simple mathematical foundations and judge the health of their business. And so we've had some form of ledger accounting for about 7,000 years ago. I think as far as I'm aware, the earliest form that we knew was in Mesopotamia. And then since we've had it advance a lot. The problem with writing is several. First of all, it's tamperable. If someone were to come in and erase it or scratch it out and replace it with something, oftentimes you wouldn't even know that happened. You also have issues with versioning. If I write down one sample and then I write something else, you need some very sophisticated methods to know that you're reading the most up-to-date, and oftentimes older versions can cause trouble with communication. There's also loss and destruction. Here you've got the famous fire of the Library of Alexandria, which is considered one of the most destructive events in human intelligence and history, where many of the great works of the classic world were lost, and now we have no access to the knowledge that they wrote down. Finally, you have issues with monopolies and oligopolies, which in no way relates to modern circumstances where you can have very high-powered centralized organizations exploit the fact that they are now in charge of communication and then take advantage of that power in different ways. And so one method that we had to overcome some of those issues is duplication. The ability to write something down again overcame some of those issues. If one version of that was tampered with, you could see it by comparing it to other versions. If you had one version that was lost in a fire, you might have another version somewhere else where it was safe. And this allowed us to maintain knowledge beyond some of the problems that we had in history. And this idea really exploded with the idea of information technologies, where now information could be reproduced at a trivial cost and spread around the world through various media. And the fact that I'm talking to you right now wouldn't be possible with this entire movement of information technology. However, we still have a lot of the same issues that we had. Real quickly, Cindy, is my, I see everybody here on the right. Is that covering up the slide, or can you not see my?
No, I can see the whole slide.
Okay, you can see the whole slide. Great.
We can't.
You can't. Okay, let's see.
The pictures on the videos on the right side are blocking the end of the screen.
Okay, how's that?
If you go to the top and choose view option side by side, then you won't get anybody covering the picture.
Okay, I think this is fine for now, and if I need that, I'll figure that out. So yeah, here you can see many times in recent history where we've had issues with the same problems we had earlier. Oftentimes you have very large intermediaries that are basically just conduits for communications of financial value or communications. And when they have errors, when they're questioned with exploiting their position as an intermediary or as a middleman, it can have very profound effects. We all remember what happened with Lehman Brothers during the financial collapse. Lehman Brothers was arguably the top firm in the world, charged with keeping track of very highly complex, often exotic financial transactions that frequently would have, often 50 or more parties to any single transaction with these very complex forms of derivatives. And despite having the top accountants and the top analysts and the top technology in the world available at their fingertips, one day they were able to reconcile all of their accounts and realize that they were what they thought was multiple $1 billion in the black turned out to be completely toxic assets, and they were collapsed within 9 days, and that led to the global financial collapse. We can also remember issues with Arthur Andersen, where they were caught burning certain records related to the Enron scandal. AWS is a common concern where most of the internet is hosted on Amazon Web Services. And yet I remember there's been at least 2 events now that I can remember where they just had one single bug or error that would lead to large geographic outages of internet. And you can, in your own browser, you're trying to access those websites, which may include Reddit or Facebook or Amazon. You wouldn't be able to access it during that downtime. And oftentimes the economic impact of these is actually in the trillion of dollars anytime a single AWS error occurs. We've also seen issues with the VA, which is just a constant nightmare and still hasn't really been reorganized in a way to overcome these issues. And most recently, we have questions over freedom of speech and the ability for a social platform to be banned from what we call deep stack technologies, which would include AWS. There seems to be agreement that various surface level apps, can moderate conversations, but when you have the core infrastructure of communications, if your telephone company were to censor conversations on the telephone, is that appropriate in a society that values free speech? That's an issue that we're diving into right now. So what if we could get the benefits of trusted storage without those trusted intermediaries? And that's where the blockchain comes in. So the blockchain refers to the technology that was created by Satoshi Nakamoto. And he released a white paper in 2008 outlining what was called Bitcoin. And all Bitcoin was a method to record the same log thousands and thousands of times, but each of these copies was controlled by a different entity. And each entity was in charge and incentivized to keep a accurate portrayal of the historical log that matched all the other servers that were engaged in the network. And in Bitcoin's case, it provided one single function, or at least originally it was intended to, and that was to keep track of payments of this, what they call a digital currency called Bitcoin. That is sort of the building block for everything else that I'm about to talk about takes place. So what exactly is a blockchain? This is a pretty good summary by Jimmy Song, but basically it's just a programmatic list of governance rules that instruct your computer on how to reach an agreement with all of the other servers in a network. And having all the computers run the same code, they can also sniff out nodes or servers that are not aligned with all the other servers in the system. So it basically provides something similar to AWS, but without Amazon in between. And that's a very simplistic analogy. But if you compare it to cloud, which AWS is a large provider, you can see that the benefits that it provides is that it's immutable. It's always synchronized. You can always derive what is the current state of the data set that you're trying to keep. There has never been downtime to the Bitcoin network, which compared to Amazon, we have seen those types of outages. And it's monopoly resistant. Given the way that Bitcoin works, it's much harder to derive a monopoly or an oligopoly within the ecosystem, just given that basically anyone with a computer can hook up to it, and anyone with any small amount of Bitcoin all of a sudden has a say in how the network is used. That said, blockchain is a terrible database. And oftentimes you hear about running just about anything over the blockchain, and yet it's probably the hardest, most difficult form of written technology that we've ever had in history. Not only that, it's also the largest attack surface, meaning that you have to get everything exactly right. And if you were to have anyone manipulate the code, it can lead to very devastating effects. So far, Bitcoin has only encountered a couple of small issues related to this, but overall it's recovered. But some other issues you get in blockchain is you get very strange, what feel very similar to the current political environment, tribalistic forces that fight, over philosophical or what are technically only technical differences, and we don't have enough knowledge to make a sure decision. And you'll get really, really toxic, vicious, tribalistic opposition to those types of events. I don't really have time to go through it, but just the history of tribalism in crypto is worth its own college course. It's also environmentally harmful. Right now, Bitcoin miners, or the computers are facilitating Bitcoin, use more power than the country of Ireland. And there's a big question of how, given that everything else is moving towards green solutions, how this may affect the environment as well as your electrical costs. It's incredibly slow. Bitcoin is capable of about 2 transactions per second. When you compare that to Visa, which is capable of about 60,000 transactions per second. It's really hard for it to serve as a medium for.
Put my picture up in case I fall asleep.
All right, what was that?
I'm about the snowman picture there, is that?
What?
The snowman
Can we get them?
Snowman?
You know which one it is. No one.
No, I have no idea.
Well, I'll show you. Nicole.
Let me wash my hands.
Stan?
Sometimes you see people with these pictures.
Sorry about that. Yeah, and on top of it, it's expensive for many of the reasons we just named. And as well as crypto has become a massive hotbed for people taking advantage of how little most of the public is aware of the technology. And it's rife with fraud and scams. You may have heard of everything from, I don't remember the exact name, ransomware, where they can actually lock up your entire computer. And now, because they're operating with cryptocurrencies, these attackers are comfortable holding your computer for ransom if you pay them with Bitcoin. We've also seen everything from scam startups to people trying to get a hold of your private keys and emptying your accounts. It's actually a very dangerous world. On top of it, blockchain can do very little. These are more or less all of the things that blockchain is actually used for. So shared economy incentives, something similar to Uber, where you want a certain behavior out of individuals. It seems to be very effective in incentivizing those individuals to pursue that particular behavior. It can also automate trust merchants or middlemen, people that we currently provide a lot of trust and oftentimes pay them a lot in order to facilitate our communications or our commercial world. It can do a lot of those functions that currently that's the best solution in the traditional world. It's censorship resistant, meaning that as long as you follow the rules that are created for the network, no one can come in and moderate the messages that you send based on their content or your philosophical agreement. Finally, the barriers to entry are lower. This one has an asterisk, given that it's very hard to get into it in the first place. But if you do have a competent developer, it actually becomes much easier. And in the meantime, they're developing solutions to allow more and more lay people to pursue many of the different functions in the crypto world without a high barrier to entry. So with this, that might be a good opportunity to take some questions. How many people are asleep, or have I lost already? Do we have Cindy?
You used
Like the question.
I'm not seeing any questions, but you used Ireland as an example of the electricity. There was a company, USI, that was a big scam with selling packets. Weren't they in Ireland, or was it Iceland, or?
I don't remember where USI, it was USI Tech. And basically what they had was an entire Ponzi scheme where if you sent them your Bitcoin, they would send you back more Bitcoin, and they guaranteed really high rates of return, something like, I want to say 20% monthly or something incredibly high. And what they were actually doing was they were accepting money from new investors to pay off old investors, and then skimming a large portion of that for themselves, and experience a high rate of growth. I don't know where they were based. I use the country of Ireland just as an example for how much electricity is consumed by the Bitcoin blockchain. In reality, where a company exists doesn't really matter in this world, because they're all connected and running against the same rules. And so ultimately, USI Tech started having problems when the district attorney's office in Texas actually filed a complaint against them. And that was the popping of that particular Ponzi scheme. I know a few people that actually lost their life savings in that event. But yeah, when I say that this ecosystem is rife with scam and fraud, if you ever see anything where someone's guaranteeing you a return of some sort, you can almost assume that that's some kind of a scam.
Okay. Somebody's asking about the mining apps on the App Store. What do you know about them? I suspect you're going to get to that in this presentation, right?
I'm not going to get much into it, but yeah, the mining apps on the cell phones, generally it doesn't make sense. The processing power of a phone is not capable. Well, for Bitcoin, for starters, we'll focus on Bitcoin. Bitcoin works by basically arbitrarily creating arbitrarily high difficulty, more or less Sudoku puzzles. They're very, very hard math problems that we can't solve in a human sense, but with enough trial and error committed by our computer, one of them will eventually find the right solution. And as more nodes join the network, this arbitrary level of difficulty, I think I'm getting some feedback here.
Somebody's not muted, please.
Okay, looks like we're better.
Okay.
And so as the what they call difficulty increases when more nodes join and it becomes more competitive, they arbitrarily increase this difficulty. And so most smartphones aren't capable of competing in that. So by and large, I would not touch any of those whatsoever. Now, there are certain blockchains that have been optimized so they can be used on very low power processing devices. They still run into the trouble of, I have a server, you have a iPhone, my server I can optimize to be stronger than yours, and they have to find a solution to that problem. But regardless, most of those blockchains they don't have much value. They aren't being traded in high volume. You'll notice that those coins tend to be incredibly volatile. They make Bitcoin look like gold in terms of volatility. So, even the semi-legitimate ones, while it's interesting how they're approaching the technology, for the end users, they're probably not useful. And yeah, I would stay away from that unless you actually know what you're doing.
And Leslie's asking, I assume you will go over the various types of blockchain. Is this due to tribalism and many wanting to do it their own way?
So I will go through a different chain called Ethereum, and that's actually my next slide. And that's a good segue. But on the other side, another version of this is the difference between Bitcoin and Bitcoin Cash. Originally, it was all one single chain. It was the Bitcoin blockchain. And then Bitcoin started becoming so popular that 2 transactions per second ended up in delays of sometimes days or even weeks to get your transaction through. And that was unacceptable. And so the question now was, should we increase an artificial limit that Satoshi Nakamoto had designed in Bitcoin called the block size limit, where he limited each block, I believe, to 1 megabyte. And so the competing views in that was, on one side, people saying, yes, let's just increase the block size. It was already arbitrary amounts. There's no reason it needs to be tied to one megabyte. And that allows us to fit more transactions in every block. And then you have the other side saying, but there's large portions of the world that can't facilitate communications much higher than 1 megabyte at a time. And so by increasing the block size, we may be excluding large portions of, say, Africa and South America and Asia from being able to participate as miners. And that would lead to centralization. And so it was a very philosophical argument between 2 sides that had, in my mind, both sides had valid views of it. But rather than come up with a solution that made everybody happy, they started making memes of their opponents that made them very disfavorable. And then printing phone. It really turned into what felt like a political party type of opposition, rather than a bunch of techies getting together and overcoming a problem. And ultimately, they couldn't come to a solution. And so what happened was, those who said, let's raise the block limit, split off and created what's called Bitcoin Cash. And so what Bitcoin Cash is basically, at a certain point in history, they took the Bitcoin ledger and then what we call forked it into 2. And now those are now parallel universes of Bitcoin running with different rules on each of them. And they both have a tremendous amount of support, but by far Bitcoin has maintained itself as the dominant factor. That may just be because of brand recognition, or it may be because most people do philosophically subscribe to their view. I can't really give insight other than the market price of Bitcoin is about 10 to 1 to Bitcoin Cash. But to move on from that to another sort of political camp, we have Ethereum. And Ethereum is the number 2 crypto asset behind Bitcoin. Its units are called ethers. And Ethereum is the world's slowest computer. It was invented by this guy right here when he was 19 years old. His name is Vitalik Buterin. And basically what he did was, he took the concept of a blockchain, but rather than having a very hard-coded programming language, he developed what they call a Turing-complete programming language that could be computed in a distributed fashion, which they call Solidity. And so what the upshot of that is, rather than being designed for one specific function like Bitcoin was for monetary transactions, Ethereum can run pretty much any type of app that you're ever being used to use. So anything from Twitter to your Amazon to Zoom right now that we're working. In theory, Solidity is a much more conducive environment for developing apps on this decentralized system of nodes. And so in that way, a lot of people don't think of ethers even as currency necessarily. It's more like oil. It's that in order to get all of these nodes to run your operations, which underlie any app that you want to use on it, you have to spend a little bit of ether to incentivize all the miners in the system to process that transaction. And so it's just a very different value when you're running, I just want to like somebody's tweet, and if I have to put in a few cents in order to do so, that's different than a system that was designed purely for recording financial transactions. So the entire environment we're working with is called the Ethereum virtual machine. This is where you get introduced to a concept called smart contracts, which we'll go over a lot of. You also have these decentralized applications, which I alluded to a little bit. You have initial coin offerings, which is what fueled the last bubble. If you guys remember, in 2017, that was the major force behind it. We'll talk about decentralized autonomous organizations. And finally, what I believe is the current catalyst behind the current crypto asset bubble is called DeFi. And we'll go through each of those. So the Ethereum virtual machine, as I mentioned, is just an environment that allows you to run any kind of app in a decentralized fashion. And so what that looks like is you have a decentralized app. Traditionally, they all go to a data center of some sort. You can imagine that as AWS or a server that's hosted by a single party. Instead, all of your devices would connect to any of the nodes in the blockchain. and they're all running redundant copies of the latest state of that app, similar to Bitcoin. And so this is a lot what a decentralized environment might look like. So we call these dApps. Now dApps allow for apps with zero downtime, synchronized edge client processing, which means it actually may be faster because you might have a miner running in your house or next door, so you don't actually have to send information packets around the world in order to know what's happening next. So it may actually be faster. You've got website and apps with native payments, so therefore you don't need PayPal or Visa or Square or any of the middle layers that we have currently in payments. There's censorship resistance. So there's one project called Gab, which competes with Parler, and they're trying to utilize this aspect of blockchain to provide a platform for social media without political interference. You've got privacy or transparency and global change. So these are examples of apps, and I include Bitcoin as an example of an app because it does one single function. But you can also think of escrow. If I want to enter a transaction with you, but we don't trust each other, currently you have to go to an escrow and place money with them and file a contract to guide their behaviors. In this, you can actually use a smart contract to code out that behavior and allow the smart contract to automatically, robotically execute the function of escrow. You can also do marketplaces and exchanges and automated contractors, but we'll go through all of this in a little bit. So the first real thrust of Ethereum that we saw was about 2017. They had these concepts of initial coin offerings. And basically all an initial coin offering is a really large crowdfunding from investors that don't know anything. And it's very easy, it turns out, to take their money. And so we had Ethereum itself was actually founded through an ICO, and this is what kind of paved the way for this to be popular in crypto. Ethereum raised $14 million in 2014 and ultimately delivered. It created the world's slowest computer, which has actually been very useful for us. And that was just on a raise of 14 million. Since then, we've had ICOs go for as much as, there was one that raised $4 billion in the course of 6 months. And this is just from individuals around the world sending cryptocurrency and essentially skirting securities laws in order to accomplish this. And so you can also imagine how rife for scams that was. And ultimately, it did turn out to be a bubble, which I think a lot of us recognized from the beginning, and that popped. And you saw ICOs, you can see right here is when the ICOs are really taking hold, 2017, and then right here is sort of the top of the bubble. This is just the price of Ethereum really followed the interest in ICOs. And towards the end of 2018, you don't really have many ICOs anymore. Another aspect of this, and I actually had a few more slides in my last presentation, but unfortunately for time, I cut them out. But it's decentralized autonomous organizations. And how these work is, you think of a traditional corporate structure, you have investors put money into a bank account that then they vote on to place shareholders who receive that, board members. And then board members are in charge of hiring the executives, which would be the CEOs and the officers. And then the officers hire the employees, and then they go about and do whatever it is they do. This is a different structure where you've got more or less investors, which are often users that put money into a smart contract, which is directed by programmatic language in that smart contract on how to operate. And it kind of cuts out the board layer compared to the traditional one. Often what you'll have is much more direct access of those who buy into a DAO. They'll receive some form of that DAO's tokens, which they can then vote on the direction of the company and upgrading the software, implementing new features, hiring contractors, a lot of different things. And so while they're still really exploring and experimenting with this, long story short is it really defies the concept of companies that we've ever had through the last 200 years. There is no central office. There is no boardroom or oftentimes even a country that these companies are registered with, and yet they're actually providing apps that generate revenue that get returned to the people who bought these DAO tokens. And it's really a fascinating place to see. There was one famous DAO that had an exploit in the hack, or exploit in the code that someone took advantage of, and ended up stealing about $130 million of all of these token holders' purchases. And just seeing these different types of mistakes, it's just incredible. Another DAOs that we've seen is called MakerDAO, and they produce stable coins. Basically, you can buy these maker tokens, which serve as their governance token, deposit them in a contract, and it issues you a unit that stays consistently worth $1. And so now you have access to a stable value asset on the blockchain, which brings all the benefits of blockchain, but doesn't go through traditional financial intermediaries. You also have Augur, which basically is the world's biggest prediction market, unregulated prediction market. Prediction markets are actually more or less illegal. They're subject to CFTC jurisdiction, and CFTC just doesn't authorize many of them at all. Now they've created a worldwide company that the CFTC can't take down, arguably. And so there's a big question, are they going to arrest the original developers, given that the original developers have nothing to do with the project anymore? It's just living based on these gamblers who like to use it. We've also seen Moloch DAO, which is an attempt for nonprofits to collect money and then have governance over nonprofits. And what that translated to in the last election cycle is the Andrew Yang DAO, which I was actually asked to be the campaign manager. But it was a DAO that basically operated as a super PAC, raised money, and actually hired some film developers. They created some commercials that were aired, entirely financed through this decentralized method. So at this point, I think might be a good time for more questions.
Okay, I'm going to catch up with some questions that might be related to previous comments. Jason, please talk about passwords. I heard they are ironclad.
No, that's a big topic. Short answer is no, passwords are not ironclad. Let's save that one for the end, because we can talk a little bit about user security,
Okay.
but we just have a lot of slides here.
All right, which wallet do you like best?
And obviously my crypto, they have a great compliance officer, but my crypto only services Ethereum and dApps. Outside of Ethereum, when I am transacting Bitcoin, I use Ledger. Ledger has a hardware component to it. So you actually have to buy this little device that plugs into your USB, and that holds your private keys. And it's much, much more secure than keeping a private key on, say, your phone or your computer, which if an attacker installs malware on your computer, for example, they can locate your private key and empty your account. These ledgers don't have that vulnerability. So I would highly encourage anyone that's holding coins, first of all, get them off an exchange. Don't leave them on Coinbase or Gemini or wherever you buy them, because if someone gets a hold of your password to that website, it doesn't matter what their private key is, they just empty your account that way. But move them into your own wallet, and ideally one that's supported by hardware like Ledger is.
Okay. In your opinion, is Bitcoin a store of value, a way to overcome the falling US dollar?
In my opinion, sure. Anything that people place value in is a store of value. And right now, people seem to place a lot of value in Bitcoin, and it keeps going up. My personal feelings on Bitcoin itself is that Bitcoin is obsolete technology. A lot of the problems that they overcome with very large political wars, other chains have taken fundamentally different approaches to throughput. Another one is to privacy. It turns out Bitcoin is not as private as everyone thought. And I've actually had federal investigators tell me that their favorite thing to happen in the world of drugs and terrorism is Bitcoin, because everyone thought it was private, and in fact they own that network completely. They know everything that's going on, and they're very sophisticated in tracking. But there's other chains that they have problems with. Monero, for example, that's what they fear biggest, is that drug dealers, by and large, will figure out what Monero is and start using it.
Okay.
So long story short, Bitcoin seems to only exist because of a first mover advantage and because of brand name recognition. And as long as it maintains those, it will always have some level of value, and that value may keep increasing. But if there's ever a point where that value wears off, then you're going to see a plummet in its price, and it may be replaced by some of these other more advanced technologies.
All right. You mentioned that data is always owned by its original owner. In a chain, what happens if they remove their data? Also, how do errors get corrected? Proliferation of conspiracy theories, for example.
That's a good, very, very complicated question. For starters, once it's on chain, it can never be removed. It's there permanently. What you can do, however, is you can modify it. So you can think of two things. You've got the blockchain itself, which is the entire history of transactions that ever occurred. And then you have the current state of the network. And that's what's available right now to use. And so what it would actually look like is you look back in the history and you could see everything that's ever happened, but you can then append it and you can modify it. And there will be a transaction showing that that modification happened, and all of the states that occur after that point, they will no longer have that. So if there, when you come to something like political difficulty, you know, and inciting group movements possibly towards violence, you know, that's a hard question. You know, and you know, that's something that we think about all the time in the industry is, are we building something that can actually tear apart society? Some people are actually happy with that. They're like, yeah, screw society. We need a new one. But yeah, probably the more grounded view is you know, we don't know quite yet, you know, but they want to solve that more on the interface layer and the middleware layer rather than tamper with the actual blockchain itself.
Okay. And I think we have a couple more.
Okay.
When blockchain first came out, I heard it would be used when people were working on some sort of collaboration. So that this has turned out to not be the case.
No, I don't understand the question.
I'm reading
Yeah, I
it
mean, everything is a
verbatim.
collaboration.
It is a collaboration.
Yeah, I mean, ICOs is a great example. ICOs, both ICOs and DAOs are great examples of how these decentralized organizations have formed totally outside of traditional means of forming a you know, a corporate entity or something like that. And yet they're creating things. And, you know, I'll go through a couple of those, and at the end I'll have one that's been highly successful and quite frankly possibly dangerous, but is really exciting nonetheless.
Okay, here's another one. I'm not understanding why a slower computer, in quotes, the world's slowest computer, would be an advantage.
Yeah, and that's a great question. Basically, it comes back to this key feature. If you don't mind the slowness, you know, are these benefits worth the trade-offs? You know, and that's really the decision that anyone developing an app needs to make. You know, I have people approach me all the time saying, I want to create LinkedIn, but on Twitter. And to me, you know, what's the problem you're trying to solve of LinkedIn? And they haven't identified that. They just like the word blockchain and they want to build a LinkedIn on blockchain. And, you know, those are very poorly thought out business plans. And I've seen them in just about every possible imagination. We'll make Tinder on the blockchain. You know, I've seen everything. So that's the trade-off, though. If these are problems, if you identify these as negatives to existing solutions, and the trade-off to using blockchain overcomes those issues, but there is high amounts of cost with it, and you know, these are all the costs, then it's worthwhile pursuing. That being said, there are a lot of attempts to overcome even these issues. There's something called layer 2 solutions, where they're coming up with sort of hybrid centralized, decentralized methods to compute a large number of transactions off of the central blockchain and then periodically sync and settle with it. So you can think of it as sort of a bar tab. You don't pay for every drink necessarily when you go to the bar. You give them a credit card, you go get hammered, and at the end of the night, you pay it. Maybe they refunded a couple drinks because they made them wrong, and you have all these transactions that happen before you actually charge it to your card. You know, that's one approach people are taking to, for example, the slowness of Ethereum. All right, I think we should keep moving.
Okay.
Yeah, 3:38. So let's run into some real world applications. I'm going to breeze through these just because there's so many and there's a couple I want to focus on. But for starters, issues that we have with DNS, you know, DNS only has, I think it's 17 central hubs that it runs to service the entire United States. And if you have anything that affects them, I believe in 2016, there was one where a kid programmed what we think is a kid programmed a malware that infected a bunch of smart devices, really low level refrigerators, TVs, thermostats, and they launched what's called a DDoS attack on one of these DNS centers, and it took down the entire West Coast's internet access. And so ENS is a concept where rather than routing everything geographically through the TCP/IP layer, instead it uses blockchain addresses as identifiers, which now they're giving a human readable form. So if you look at a blockchain address, it's going to be a whole bunch of random characters that are hard to understand. ENS is a method in Ethereum that you can say, you know, JSON.eth will direct you to this address, which you can then store relays to access the website. We're also looking at fair business models, data business models, where you have much higher amounts of control of what happens to the data that you create. based on it can only be accessed with your permission. So if you go into a bar, you know, and they want to know how old you are, there's no reason you have to give that bartender your address and your name or anything else. They only care about one slice of information. And so there's models that are where you could disclose your age as verifiable without sharing any other data. And so there's attempts at that in the medical community, all over the place. We're seeing that. But these projects I named are specifically trying to become a pseudo State Department or DMV, which is sort of a central repository for folks' data. But I shouldn't say central, a decentralized repository for folks' data. Another one that could probably be its own class, and yet I only have one slide on it, is called non-fungible tokens. Non-fungible tokens, if you think about the internet, there's nothing that exists in the legacy internet that is fixed and you can't duplicate. So for example, a JPEG, it's hard to own a JPEG because all you have to do is hit copy paste, and every time you share it with someone, now they have the ability to share it with theirs. NFTs is a different form where rather than creating a whole bunch of crypto tokens that are all worth the same value, they only identify ownership of one specific asset, and there might be rules coded into that. And so possibly the most highly visible or successful NFT project we've ever seen is called CryptoKitties. And it's where you can buy these cute little cats, and each one of them is fully unique. And then you could go ahead and you can mate them. And you have their tokens, which are encoded with what they call DNA, that you can then share, and based on probabilistic outcomes, will create a new cat that somebody drew, and yet you're the only owner of that cat. And it's very much a fad sort of oriented application, but you could think of how this may be used from everything for collectibles. You can think about how it's used for art, proving ownership of a work of art that's hanging in a museum. You can also think of how this might be used for video games. Right now, video games have, if you're playing World of Warcraft, you have Warcraft Gold, you have a Warcraft Sword. Maybe you could use the gold in other games that are created by Blizzard, but you can't use it, for example, in EA games. You can't use it in Madden. So what this allows is that you can create these central assets in any game or even outside the games themselves. And now if Warcraft or Madden plug in and read that you own this token, now you can have this special sword, or you can have this player that no one else can get, or the player's costume that no one can get. And so it really opens up the ability in video gaming, which is probably where we see the most development of this concept. But I'm also seeing it everywhere else. A lot of the younger generations, Instagram influencers are now, the very highest level influencers are now creating these collectibles that they can sell to their followers at an incredibly, almost ridiculously high value. And yet these people are happy to show and prove that they own whatever the collectible is. And they aren't worried if the artwork itself is shared, in copy and paste. They're still the only owner of this asset. And there seems to be a large amount of value in sort of the collectability, just saying that you own something. Pretty much anything involving any of the other cutting technologies that you've heard of, there's explorations of how to bring that to the blockchain. You see everything from Internet of Things, augmented reality, 3D printing, drones. There's attempts to integrate blockchain as sort of the financial layer that allows all these different robots to trade with each other, more or less. We've seen it in shipping logistics, everything from keeping track of, a head of lettuce is grown on a certain farm. There are attempts to show that this came from this farm to your plate. Now you can know if there's salmonella on it. You can know how fresh it was. You can see a picture of your Thanksgiving turkey when I was a kid, things like that. Now there's real estate. If you think of that NFT concept that I described, you can now encode rules around a specific parcel of land, and it would completely, arguably it could completely replace the system that land management currently undergoes, where you have to go to your local city or county hall and dig through boxes, or have someone dig through boxes for you to locate a title deed and relocate. Tracing the history of real estate is incredibly difficult. There's a lot of people who are exploring how to use blockchain to replace that. Here are a few other examples. We've seen finance and bank accounts, which actually that'll be the next section of my slides, so I'll skip over that one. We've seen it in healthcare, from everything for keeping care of your data in a way that's HIPAA compliant, and yet you can instruct your doctor to share your file with, say, your surgeon or specialist. That doesn't require faxing, which seems to be the most common way right now in healthcare. You've got electricity. Now you have this interesting phenomenon where you have a lot of end users of electricity are now producing electricity themselves, often through solar. And they sell it back to the grid. And there's a lot of questions and a lot of controversy swirling the central organizers of this and their accounting of that, and questions as to whether they're actually tampering with the numbers in order to gain an advantage. And so if you had a way to mete out how much electricity you produced and it was verifiably linked to a certain crypto asset or something, it would eliminate that possibility. So this is the real, what I believe is the current catalyst for the current bubble that we're currently going through. It's called decentralized finance. And let's see what it is. Yeah, decentralized finance is basically a large movement of projects that are attempting to provide every function that any kind of bank you've ever heard of provides, but in a decentralized fashion. And so, I'll go through what that actually means right now. But the attention and the interest in the DeFi ecosystem that has happened in the last 6 months to a year has been phenomenal, and we have just been seeing. I think it's reflected in the price of Ethereum and Bitcoin, the movement of these. And to me, this is actually the most exciting current cutting edge situation for the technology. So the first real use of DeFi that we've seen is called DEXs, which are decentralized exchanges. So you think of a traditional stock exchange, everything is facilitated by the New York Stock Exchange, and that's all owned by, forgetting his name, he's the husband of Loeffler, who was the failed Georgia senator candidate, former senator. But he owns the entire thing and has a tremendous amount of power, given that he can say yes or no to whether a stock gets listed, how it's marketed, how the exchange operates. What happens instead in DEXs is that you can actually submit basically a market maker for both sides of a transaction. Let's say the transaction is Bitcoin for Ether. You can put both tokens into a smart contract, and then users trade against that, and they actually are naturally incentivized to perform arbitrage in the DEX to maintain the price of transactions with the real world counterparts, with the centralized counterparts. And recently, DEX volume has eclipsed centralized crypto asset exchange volume, which is a really phenomenal event if you really can wrap your mind around that. Here, you can see the pattern of the liquidity available in these DEXs, and you can see where we're at right now. It does largely follow price, but we're talking about we're still only in the range of billions per day, which is still a very small number compared to the world's assets. And by the way, this is only for the biggest DEX, which is known as Uniswap. There's actually probably anywhere between 20 and 100 versions of DEXs that you can use right now and have some level of liquidity and usability. So yeah, just disintermediating everything that you think of in a stock transaction, where it has an exchange and a transfer agent, and a broker. A lot of the functions of those middlemen who all take a very high cut of any single stock transaction that occurs. This removes the need for them and can provide the same level of accountability for a very, very tiny fraction of that price. Some of the other banking functions that we've seen lending. So you can borrow against a pool of collateralized assets. And there's different debt functionality and insurance that you don't even need a credit score. There's a way that they ensure that you can collect on any debts that you give out using some of the blockchain programmatic features. We've also seen insurance, and Cover is actually a funny one. The goal of Cover was to insure against hacks on other DeFi protocols. And so they created this giant pool of wealth that if other protocols incorporated their insurance and paid for the insurance, if they ever suffered a hack or an exploit, Cover would step in and cover the costs, which sounds like great. This is fantastic for crypto. But then about 3 weeks ago, Cover itself got hacked. And of course, Cover can't insure itself. And someone drained all those pools. So it's just another kind of funny, who watches the Watchmen type of occurrence in crypto. And then we already talked a little bit about MakerDAI, that produces the stable assets that follow the value of $1. And that unlocks a lot of commercial activity, given that you can have crypto assets without using centralized fiat. The big one though is derivatives, and this one I can't really explain on a slide, so I have one of my favorite charts to look at it. This is actually an old chart. This is from 2016, so the numbers might be a bit different, but the concept basically applies. And so here you can see each block is worth $100 billion. So here you have silver, which is just barely a block. You've got cryptocurrencies, which is probably much bigger than this was in 2016, but still, here's some scale. These are each of the largest companies. You got Amazon, Apple. Crypto probably eclipse any individual one of these companies now. You've got the world's 50 richest people, which actually would be bigger now because during the pandemic, they've actually accumulated a large amount of wealth. You've got California's GDP, Fed's balance sheet. This is all of the hard currency that exists in the world. This is Euro, USA, China, Japan, and everybody else. And here's all of the gold in the world. This is the value of all gold. And then here's stocks. And you can see how much more value there is actually in the stock market than there is in actual currency in gold. And then you can see this is the entire global money supply, which includes banknotes, money market accounts, and basically what on accounting balance sheet calls as cash substitutes or cash equivalents. And you can see how much more cash equivalents there are than actual narrow money, which is just this top portion. You then have the global debt. This is all the money that all of the countries and everybody owes. You've got global real estate, which still is ahead of global debt, although it might not be after the pandemic. Then you have derivatives, which is basically just options, swaps, futures, and forwards, and it's different products based on those four concepts. But I don't think people really understand how big the derivatives market is compared to this is where all the money is. This is all the money. Everything else is a drop in the bucket. It's incredible when you actually understand how the world's financial power works. It isn't on who has the most wealth or the most currency. It's really tied up in these derivatives markets. And so on that note, we're working to decentralize that. And when you think of all of the, both shadow banking sphere as well as the biggest bank names that you've heard of, the Goldman Sachs and Morgan Stanleys of the world, this is what they do. And this is why they are considered too big to fail. Is that, we saw Lehman Brothers go under and that shocked the entire world. These companies have so much power manifested in them that any collapse can destroy people's retirement accounts, homes, living situation across the planet. And when you think of how severe that is, it is amazing to think of how much power the derivative markets really hold. So this project that I actually I have represented in the past, although the company went out of business in the most successful way possible, and I'll talk about that a little bit, it's called Synthetics. And so what Synthetics allows you to do is you deposit Synthetics tokens, SNX, as collateral, and you have to over collateralize, but you can then mint synths. And so synths, similar to Maker DAI, which we covered a minute ago, they hold a value of $1 US. And so if I want to mint $1 US, right now I have to put in $5 worth of SNX collateral, and that allows it to maintain the system. And then anyone who mints these synths is rewarded for doing so. So it has a natural incentive to constantly be increasing this global decentralized collateral pool. But then what you can do with those USDs, those SUSDs, is you can then convert them into other currencies. And so these are a lot of the different currencies that it currently tracks. You can long and short cryptocurrencies, which is a very popular feature. If you think Bitcoin is going to go down, rather than creating a margin account with a investment broker, they will just mint you a token that follows a value that increases in proportion to the decrease in Bitcoin. We also have seen it representations of commodities. We've got gold, silver right here, and pretty soon I think they've actually already launched tokens that follow the value of Apple and of Tesla, and those tokens allow you to get exposure to the price movement, but it doesn't require you to actually buy shares of the company. And it all works through everything I described. It's a little bit more complicated. But if there's either you don't want to pay for the intermediaries involved in those stock purchases, but you want exposure to the price, or if there's other reasons that you're restricted from operating the markets, for example, if you're not an accredited investor in the U.S., you're locked out a large portion of the securities markets. This has created a way for anybody to access those financial markets. And then when you start using these building blocks, now you can start creating complex derivatives basically that mirror the services provided by JP Morgan and Goldman Sachs and those likes, but fully decentralized. And I got involved in the project. So yeah, about January of last year. And I remember I was doing my research for the project, and I got into this and I said, wow, this is actually a much further developed project than I've ever come across. They have already 100 companies that are plugged in using this and growing. They have a robust ecosystem, a very lively user base. And so we assisted them. And right around this point, they actually went out of business. And what that means is they folded their centralized entity and reverted all control to the holders of SNX tokens. And so now it's running as a fully functional DAO, which means now it's going to be very hard to take down. And in the meantime, it is just going through a complete hockey stick of eating up this entire set of little boxes that we were just looking at. Now, that being said, it's still only at about $2.5 billion worth of assets locked in this protocol. But yeah, I mean, as the system develops, as people improve certain features of it, synthetics itself might be replaced by the next version of this. But I'm really excited to see how this works. You know, Bitcoin always aimed for the Fed and control of the currency. This is actually attacking the centralized holders of the global financial system in much bigger ways. And with that, I think hey, 4 minutes left, and I guess we can run over with some questions. Anybody have any questions for me?
I have a question. You are, let's say you market the My Crypto wallet.
I'm the
How do
compliance
you market
officer.
it?
That's a great question. We don't really. So there's a lot of history with My Crypto. Originally, we were a company called My Ether Wallet, and we were just the first client-side wallet that was hyper secure, available on the Ethereum network. And the company got started in 2015, so we were just the first one there. However, the two founders of it, Taylor and Kosala, got into a founder dispute and ended up parting ways. And it actually split into two companies. And neither company owns, its intellectual property portfolio is tiny. The only thing there is basically the logo and the social media handles. Everything else is open source and available for free, allowing anyone to rip off of it. So what My Crypto did was it ripped everything out of My Ether wallet, and 19 of the 20 employees went off and started My Crypto. And My Ether wallet had to sort of start from scratch, but they still had the brand name. But the long story short of that is because they have the brand name, they just have a very natural permeation of users, and they constantly get word of mouth. Whereas for us, we're much deeper involved with the Ethereum insiders and the hardcore users, high net worth users, as well as core developers, et cetera. And so we just, one of the sort of gateways to entry to be considered one of the cool kids in Ethereum is using our product. And so we're trying to figure out how to branch out of that and actually make some money out of this. But that's where we are right now.
Okay, here's another question. Where can you buy synthetics?
Through Uniswap. So when I was talking about that DEX earlier, I think synthetics is only available on the DEXs. So it does require a learning curve. You have to buy crypto. You have US dollars right now. And the only way to go from US dollars to crypto is through these centralized exchanges. So that would be Coinbase, Kraken, Gemini, et cetera. Once you're in crypto, then you pull it off of those exchanges, and now you send it to your own wallet. And now you can interact with these decentralized exchanges. And the most useful, let me share my screen real quick, and I'll show you this tool that I use.
Isn't Coinbase a wallet itself?
No, they have a wallet. They use the word wallet in a way that I wouldn't consider the same. They're just they're more of a custodian. It would be the same way as saying like a bank account is a wallet. It's not. Your wallet is your wallet. The wallet in your back of your pocket is a wallet. Just because when you put your money in your bank account, that doesn't put it into your wallet, even if you can use it like that. They're still actually holding the money. And so Coinbase is very similar to that. But this tool that I have called MetaMask, right here, and you're now exposed to my personal day-to-day wallet. What this allows us to do is if we go to, for example, here's the synthetics minter, or we could even go to Uniswap. I'll show you. So MetaMask is just a plugin. You can get it on the Chrome store. You'll send money to your address right there. And then now you just come to Uniswap. And as long as you have MetaMask enabled, it knows what your balance is. So if I go here and say connect to MetaMask, now you can see the same values pop up. And what's really fascinating about this is there's no login for this. So you don't need to remember all these ridiculous passwords and things. As long as you have MetaMask enabled, you can operate your wallet through any of these different services. And so let's say you want to buy, you want to convert 0.1 ETH to, what's good, we'll just look at, well, here's synthetics, that'll tell you how much you're going to make. And then you hit swap and it's going to tell you, this is the tiny fee that it pays off to to Uniswap holders. And then there's also going to be gas prices that come up. Let's see, where's the gas? They don't even list it here, but yeah, if you see over here on the right, MetaMask pops back up, says, do you want to confirm this transaction? And you can even go in and edit the gas. And this is how much I'll actually be paying for the transaction. This goes to the entire Ethereum blockchain. It isn't going to the decentralized exchange. So you can actually see it's a little bit expensive for hobbyists to get involved in. If you're only trading $20 and it's $8 to conduct the transaction, that's not really worth it. But if you're trading the range of tens of thousands or hundreds of thousands, this is much cheaper than you would get through a decentralized exchange. Did that answer the question?
Yeah, kind of.
Let's see. Fabulous talk, Jason, and thank you, Cindy and Palm Beach Mensa for hosting. Enjoy the rest of the day. So one of the guys.
Oh, yeah.
I'm not seeing any other questions. Personally, this is like learning a brand new language for me.
Yeah, I was a little worried that it'd go too fast. So yeah, if anyone has questions, please, we can go ahead and mute it if that's easier than typing into the chat.
Yeah, let y'all, everybody unmute and go ahead and ask questions away.
This is very, very basic. What is this mining? How do you mine stuff?
How do you mine stuff? So yeah, when I said there were thousands of servers or computers that all have figured out how to work together, those are miners, and that's it. So each of those is incentivized to keep track of all the other servers, and they can all work in a coordinated fashion without a risk of one of them being fraudulent or malicious. And that's it. And then so as long as you're spending power, you leave your computer on and it's plugged into the wall, you'll receive a certain amount of, say, Bitcoin if you're mining Bitcoin, to confirm those transactions and to process all the transactions that come in.
Jason, I had mentioned, and for Amy, I don't even remember how many years ago, 8 years ago or something, my son, who's 22 now, he got into bit mining. And I didn't even know what it was. He was a gamer, and he bought a device off of Amazon. And that thing ran 24 hours, then it burnt out, then he got another one, then he headed off to college. That thing would beep in the middle of the night because it'd go offline. It'd wake me up and I'd have to go reset the bit miner. And I'm like, what is this? Why am I doing this? And it was hot in his room. I'm like, what's going on? And unfortunately, he used most of it for gaming versus holding on to the Bitcoins, which would be nice now.
Go figure.
I think first started hearing about Bitcoin and values going up, maybe he had, $500 worth or something left, but he did it for a very long time until finally his bit miner wore out, and so many people were doing it. It was too costly to, for a college kid to buy a bit miner anymore. But when it first started, it wasn't that expensive.
No, I assembled my first miner. They're cheap to buy and the price dips. Because no one else is mining at that time. And so I bought all of my equipment in 2016, and then a bunch of gamers got mad at me for doing so because I was just putting it on these cryptocurrencies and they all wanted it to run their graphics cards. But yeah, it sounds like you're a good parent.
But it's interesting because I'm a financial planner, and I have a client right now who probably a couple weeks ago said, Leslie, I want to pay you to learn about, and he's really interested in, I can't remember now what it's called. I just remember it's ADA.
Oh, Cardano.
Yeah, okay. So I have been digging, trying to understand this. So I've impressed him because I understand hot wallets and cold wallets. I understand makers and takers. And we did open an account at Kraken. And now we're kind of at the point of, what is this? We have to wire money in. And he's kind of like, wait, I thought I could use my IRA. And, and I don't want my wife to know about it. So we're stopped right now. And I said, listen, I have 2 webinars this week on on blockchain. So we're going to reconvene. But anyway, this has been excellent. This has been excellent. So
I hope it's helpful, and I do offer. My pipeline's just been full with the price, but I do offer consulting services specifically for this. If it's something your client's interested in, maybe we could work something out.
I like that. Thank you.
Yeah, no problem. And for what it's worth, Cardano, just a little history on that. Cardano has taken an approach where blockchain tends to be tech solutions are devised by engineers around the world, circulated on GitHub, and they let it go. Cardano has taken a very stern approach that we're going to slow down development and have everything peer reviewed and researched in academic circles. So that's maybe the key distinguishing feature between it and others, is that its development moves much slower, but they hold a trust for the academic process that the other people kind of move too fast for.
Interesting. Thank you.
Okay, well, I'm not seeing any other questions in the chat room.
Jason, excuse me. Thank you so much for this presentation. Unfortunately, I was late, and I'm wondering if it's being recorded.
It is. We'll be putting it on our Facebook page.
Okay, thank you, Cindy.
That's probably good for everybody, because a lot of that probably went over some heads. So if you want to go back and slow it down to halftime, sorry for driving through so much in one presentation.
Actually, I got stuck at early. You mentioned a thing about tribalism and its effect on things, and I don't really know what that is. I'm going to have to go look it up and find out more about the concept of tribalism and its effect on.
Oh, you're very aware of it. If you've seen riots in the last year, whether they were on the Senate,
Yes.
it's the same sort of political forces. My philosophy on it is that, we don't have a crystal ball. We don't always know the right answer to things. And so people have disagreements about what they think is coming in the future or what the right solution is to achieve an outcome. And maybe they don't even agree on what the outcome should be. And that leads to very emotional and passionate differences that can ultimately have, I think, started every war in the history of the world. And that's tribalism. And so we see that a lot in crypto, because a lot of this is unknown. And you have these different approaches to technology where people don't know or don't agree on the outcome or on what's going to happen next. And you just see the same level of just bitterness. And, if you've spent any time on chat boards on YouTube, where a Republican says this and you see all the liberals in the comments calling them names, or vice versa, you'll see the same where an Ethereum person will post something and all the Bitcoiners comment and attack them and call them names and make silly memes about them. So tribalism is actually something that it's tribes, it's something you've probably seen a lot in your life.
Well, yeah, the tribalism in general. I didn't know there was Bitcoin tribalism. That
It's dark, yeah, and it's affected people's holdings, and it scares away investment oftentimes. I was talking about the Bitcoin versus Bitcoin Cash split. Things are kind of settled down now, but at the time there was a lot of questions: is that going to be the death of Bitcoin? Not even whether either side is right, but the fact that they can't get along. But it looks like one of the chains has still dominated.
Okay, we have a question. Aside from Bitcoin and Ethereum, what are your favorite investment picks?
Yeah, and I don't really dive into that much. I
And
think
you won't be
synthetics,
sued for answering this question.
and I've got it in writing, right? And synthetics is probably one of the projects I'm most excited about. I think ones that still have life in them. And generally, I don't really play the day-to-day markets. I bought a bunch of Ether and a bunch of Bitcoin early on. I got into synthetics early on. My approach is just to buy into something that I'm confident in and contribute to it to help its success. And so those are all projects that I'm deeply involved with. But ones that I'm not so involved with that I think are worth looking at, there's Polkadot, which is kind of an approach to middleware and communication between blockchains that started by the guy who actually wrote the Ethereum, what they call the yellow paper, which outlined Solidity and allowed Ethereum to become what it is. He's now left the Ethereum community and started his own called Polkadot, and it's really doing well. Cardano's interesting, which we talked about. But realistically, I think the base layer tokens tend to be the safest, and also they're just going to, the dominance by Bitcoin and Ethereum are there. It's going to be hard for anyone to eat their market share. And so now you want to start looking at the second layers, some of these interesting dApps. And by far, the SNX is, I think, the only non-Ether token. I don't think I have many other tokens other than just Ether, Bitcoin, and a good holding with SNX right now.
Okay. Well, I think that's a wrap. And Jason, thank you so much for devoting your time to
Oh, no problem.
educating us in this whole world of Bitcoin and
I hope it was helpful, and now you can speak with your kids who are going off to college in mining and have a good conversation with them.
So this was
Thank you,
just over an
Jason.
hour, so I'm going to watch it again because there's no way I absorbed everything you mentioned.
There was a lot. Yeah, feel free to reach out to me on Facebook, email. If you have a Twitter, please follow me.
Okay.
Yeah, feel free to reach out.
Sounds
Thank you,
good.
Jason.
Thank you very
Okay,
much.
everybody. Well, great
That's really
seeing
much
everybody.
Bye.
Hi, thank you.
Bye-bye.
Bye-bye. Thank you so much.
Thank you again, Jason. I'll send you the YouTube link.
Appreciate it. Thanks, guys.
Okay.
Take care.
Thank you.
Hi, Teresa.
Bye now.